Right, good afternoon, folks. We're getting a critical mass of people here. Um, the wonderful thing about technology nowadays, we've got over 1,000 people registered for this webinar, and it's a great opportunity to bring a lot of our great minds together to share our thoughts on the market with you. So this is our Where Will the Money Be Made webinar. We do this quarterly. It's a little bit later in the second quarter of this year, after the tumultuous events of April. And if you recall, markets were moving 5 to 10% in a day. We decided to kind of delay a little bit to get a sanity check. I'm going to be introducing our guest speakers today. I'm Peter Armitage. I'm the co-founder and co-CIO of Anchor Capital. I'm joined by Dion Goos, the Chief Investment Officer of Credo, a business that we merged with last year. Nolan Wapenaar, Head of Fixed Income and co-CIO, Mike Gresty and James Bennett. So let's get on with the events of the day. Right. So I think just to remind those of you who don't know who Anchor is, if it happens to be your first time, this is something we do quite regularly. Anchor is a business that started in 2012. We're proud to where we've got to, and we're sitting with about 250 billion rand of assets across our group, and that's about 150 billion in Anchor itself. And we merged with Credo, a 25-year-old, very high quality London wealth management business and asset management business, in October last year. And we're very chuffed and proud to have Dion Goos talking to us about equities later on today. So we're servicing you from asset management licenses and businesses in South Africa, London, and Mauritius. To summarize the message that we're going to communicate with you today, from a domestic equity point of view, Mike Gresty is going to run through and tell you why it's actually been, so the performance of the index hasn't been too bad, but it's become a lot more challenging for domestic stocks. That's been overshadowed a little by the massive outperformance of gold. The post-election optimism is moderating. We're obviously all looking at the government of national unity, and it feels a little bit like it's parents staying together for the sake of the children, but we'll see where that goes. From a domestic equity point of view, we've moved to a neutral allocation. We think you could still get about an 11% return out of that over the next 12 months. But with the greater uncertainty and low GDP growth as a result of both the global events and some own goals from an SA perspective, you need some more diversification. And as always, we have an emphasis on quality. From a global equity perspective, if you went on holiday during April, you would have thought not much happened. And the market ended just marginally down for the month of April. But during the month, some massive volatility brought on by the actions of Trump, which the speakers will talk to you a little bit more about. I think the recovery from the very bottom, the market started the year just above 6,000. It's sitting at about 5,600 now in the S&P. But the bounce back from kind of the 5,000 level means that valuations are at relatively elevated levels. We still got to see what the US policy changes, the impact it's had on GDP and company earnings. And from a short-term perspective, we're retaining a neutral allocation, a 6% return over the next 12 months. But as you'll hear from Dion, for us, the best and the real money is made in equities over time. We encourage people to stick with them. If you don't have equities in your portfolio, it's probably quite a good time to add. But I think we are, since the beginning of the year, we were expressing some caution from a short-term perspective, given the valuation levels, and that really has been borne out. But you'll hear more from Dion about the long-term merits of equities. From a domestic fixed income perspective, we think you can get 2 interest rate cuts in South Africa. Nolan Wapenaar will tell you more about that. That's not nearly enough. We think our Reserve Bank governor is far too obsessed with the currency and keeping rates quite high. But the fundamentals certainly have stagnated. Because rates are high, if you have money, that's good news. Our core income fund is yielding about 8.5% with low risk. Nolan will tell you that we would blend in a little bit of flexible income to benefit from potential rate cuts. And then from a global fixed income perspective, we think cash and short-dated bonds are attractive. We think in the States you could get 2 rate cuts in 2025. That's 0.5% in total to 3.75. And it's ideal to hold bonds at 3 to 5% to maturity. Our global high yield fund is showing a yield of 5.5% with bonds maturing 26 to 29. So you've got a fair amount of certainty. So this is from our Navigator, a comprehensive document we put out once a quarter. And you can see probably for the first time since we started 10 or 11 years ago, a fairly neutral view on most asset classes. I think we're kind of sticking with the asset allocation and the shares that we've got. From a local equity perspective, we think kind of a 10, 11%. And from the bond market, about an 11% return. So that's pretty meaningful. Inflation beating returns that come through. So we'd remain invested. But our bullish, we were a lot more bullish. If you look back 6 and 12 months ago, that's certainly been the reality. And we'll talk to you a little bit about alternatives where we think there's probably better returns with a lot less volatility. From a global perspective, government bonds are always the starting point. Their US 10-year government bond yields are sitting at about 4.25%, 4.3%. We think you can get a little bit of capital appreciation on top of that, giving you about a 6% return. We're not going massively overweight equities. We're sitting neutral. We remain positive in equities long term. But the reality is that equities are fairly expensive in the context of history. On the right-hand side is the range of outcomes. And you can see from an equity perspective, if the Trump madness were to continue, that might well, there's downside. But, we do think that sanity will prevail, but the US will emerge in a position, which is negative relative to a month ago. One of the most significant factors, the equity market hasn't been that badly hit if you look at it from now versus the beginning of the year. Probably the most significant is the increase in the gold price and the 10% weakening of the dollar. So from a very strong dollar towards the end of last year, about a 10% weakening. Now that's good for the US market and for US companies who are bringing earnings back into America. But obviously from a European perspective, that puts quite a bit of pressure because their exports aren't going to be as profitable for them. This is a chart of equity markets around the world. You can see what I've circled there. On a year-to-date basis, the MSCI World is down about 1%. So, if you take into account all of the hectic headlines and big moves, where we've landed up is roughly flat for the year. But within that, and you can see the red lines there, the FANGs and the NASDAQ 100 down 6 or 7%. This is the equity market picture. The S&P on the left-hand side, the MSCI World on the right-hand side. And you can see this is the valuation. So the price you're having to pay for companies is sitting still a fair bit after the bounce we've had, a fair bit above median valuations. And this is what's prevented us from being outright very bullish on equities. Turning to alternative investments, where in our asset allocation table, it's looking pretty attractive on a relative and absolute basis at the moment. Alternative investments, the spectrum that they cover is largely assets that don't mark to market and with prices swinging all over the place, and tend to be non-listed assets. So that covers private equity. We've got some money with some of the best private equity players in the world, some very attractive opportunities. We have a bit of gearing. The opportunities which have got projected returns of 15 to 20%. And we enable you in the funds that we've created to get access to that. Alongside that, some private real estate. Private real estate, if properly managed and conservatively grown, can be an excellent investment. And we've backed some of the best players in the world within the private equity space. These funds also contain some hedge funds and structured products. Structured products are where you do a contract with a bank to create a defined outcome. And then private debt. Since Basel and since 2008, banks have really tightened up globally in terms of who they're prepared to lend money to, the size and duration. And that's given rise to the growth of an industry where SA, we can get kind of 12 to 14% yields, globally 6 to 8% yields, and it forms a very nice foundation for an alternative investment business. So this is a trend that's happening globally. For those of you who watch Bloomberg's and follow global markets, access to private capital markets is something that's talked about a lot. At Anchor, we like to be entrepreneurial and proactive. And about 2 years ago, we started some funds which have a mixture of the assets that we talked about before. The objective is to get a 12 to 15% Rand return coming through. This is the fund that we launched almost 2 years ago from a local perspective. And you can see a nice steady uptick running at about 12% per annum. From a global perspective, we have the Prime Global Opportunities Fund. Again, since we started almost 2 years ago, up about 17%. And, irrespective with a very low correlation to markets, just ticking up at that kind of 10% per annum in dollars. And then for yielding investments, our Stable Alternatives Fund, all of the return comes from coupons coming through. So it's a steady return month by month. And that's done 10% in dollars for the last 12 months. So, in the alternative investment space, we think we've created some nice vehicles. But the other guys will be telling us about the actual more vanilla or more traditional asset classes. And we'll start off by chatting to Dion Gous. And if anybody's got any questions, please put them in the Q&A after everybody's chatted, and we'll run through and have a Q&A session. But over to you, Dion.
Thank you, Peter. Just sharing my screen here. Oh, that works. Thank you, ladies and gentlemen. It's a pleasure to be presenting on this forum for the first time. And although my headline says that it's a side of Trump, I have to apologize in advance because it will feel a bit like more of a main course today. And it's just a function of the times that we're in. I don't know about you, but I'm personally getting a little bit sick of listening to Trump and talking about him. I saw something on the weekend where they said that the trouble with Donald Trump jokes is that the Republicans don't find them funny and that the Democrats don't think that they're jokes. And I think that sort of sums it up. But be that as it may, it has been quite relevant in the past few months, and certainly the last month and a half, last couple of months, I guess. And in fact, just to illustrate, 2 months ago, I was on a roadshow with Old Mutual International. You can see the gentlemen with me there. You may recognize some of them. And we went around the country and we asked the audience to give us these sort of word maps or word clouds via the Slido app, and to tell us what they wanted us to talk about and answer questions about. And you can see from Durban on the 3rd of March, which was Monday, to Cape Town on the Friday, Trump essentially dominated every conversation. You can see it by the position of Trump in the middle there. And if you look closely, you'll see it's a slightly bigger font than some of the others as well, which means that it had the most mentions. In fact, in Pretoria, it was mentioned 4 times. I think that TRYMP was also Trump. Not everybody in Pretoria can spell Trump. But that's really what people want to talk about. In fact, interestingly enough, the only crowd that didn't have Trump as number 1 was Cape Town. I'm not sure what that says of the Cape Townians. Perhaps they've got better priorities than the rest of us. But Trump was still a close second. And this was 2 months ago. This was a full month before Liberation Day. So it was certainly prescient that people were worried about it a couple of months ago. Liberation Day, you've heard a lot about. You've seen this picture. I think it will be one of the pictures that defines Donald Trump's second term as a president, the day that he announced all these ill-conceived tariffs. I'm not going to go into the flawed maths that sat behind them. I will just point out, as I'm sure you've heard, there's a place called the Heard and McDonald Islands, and it's literally in the middle between South Africa, Perth, and Antarctica. There's not much that goes on there. In fact, the only product that makes it around the world is guano, but yet that island has now been tariffed by 10% as well by the States. Now, if that seems absurd, it is, because it is quite absurd, as is a lot of the other tariffs that have been promulgated, but be that as it may. Clearly, the market didn't much like it. The day after, this is not actually Liberation Day, the market was closed when these announcements were made, but the day after was the worst day for the S&P since the worst of the pandemic 5 years ago. And if you haven't seen one of these heat maps yet, I'm sure you have, but just broadly speaking, the size of each block there is not to scale all of it, but to some extent indicative of the size of these companies in the index. So you can see on the left-hand side there, those 6 companies, Apple, Amazon, Microsoft, Google, NVIDIA, Meta, all part of the so-called Magnificent Seven. Tesla as well on the top there, just right of middle. You can see a terrible day for all those Magnificent Seven companies. It wasn't such a magnificent day for them. If you cast your mind back to inauguration, where Zuckerberg and Jobs and the others were standing next to Donald Trump on stage when he was being inaugurated, you can see that slightly startled look by Zuckerberg on the left and by Bezos in the middle. Perhaps they should have seen what was coming, when the tariffs were eventually going to affect their companies. I'm not going to go into all the reasons why tariffs are bad. I know Donald Trump still spins it as if it's a good idea, and those in his payroll parrot the same words behind him. But I think, as I said in my last column for the Financial Mail, I don't think any serious commentator who's not on his payroll agrees that the tariffs make any sense. And I think the best article that I read about this was very early. In fact, it was before the tariffs were announced, by David Kelly. I recommend that those of you who are interested perhaps find this on the internet. I'm only going to read one short paragraph to you verbatim from this article, because I think that's the best summary I ever saw about the trouble with tariffs. And it goes as follows. He says, the trouble with tariffs, to be succinct, is that they raise prices, slow economic growth, cut profits, increase unemployment, worsen inequality, diminish productivity, and increase global tensions. Other than that, they're fine. Now, honestly, ladies and gentlemen, I can't really add much to that, except perhaps this comment, which was from Thursday last week, when Apple, the largest company in the index, announced their earnings. And they made the point that they will have extra costs because of tariffs of nearly $1 billion per quarter. That means $4 billion extra cost, $4 billion less profit, $4 billion less for investors. And that just proves and underlines the fact that the tariffs are not eaten by the other country. They're not eaten by the selling company in China. They will ultimately be eaten by either the American company that imports or by the consumer in the form of high prices, or in many cases, by a combination of both. And clearly that has an impact on the market, on valuations, and ultimately the prospect for equities. About a month ago, I was in South Africa, and I was at a think tank where I was asked the question, is what Donald Trump has done in terms of tariffs, is it a so-called black swan for the markets? Now, I'm not going to go into the whole background to black swans. I'm sure most people on the call know that a black swan is shorthand today for the biggest risks in investing and elsewhere, the so-called unknowns out there. And it's largely thanks to the work of Nassim Taleb in his 2 books from 20 years and 25 years ago. So the question was this an unknown? Is this something we could have seen coming? And sadly, the answer is yes. So if we didn't prepare for it, really, the joke's on us. This is a cartoon from the New Yorker magazine from August 2016. This was before Donald Trump was in charge the first time. And even though there's no political specific or explicit political reference in this cartoon, we all know what they meant. The campaign was starting to gather momentum in August 2016. And Donald Trump told us in August 2016 he was going to eat us. It's just taken him a while to get to that point. At the depth of despair in the market that we saw a month or so ago, this memo from Howard Marks crossed my desk. Now, for those who don't know Howard Marks, seriously, if there's only a handful or less than a handful of people in the investment industry that you want to follow and who you want to read regularly, you can find all his stuff on the internet. He's the founder and chairman and chief investment officer of Oaktree in the US. And he wrote a beautiful piece where he essentially said that a lot of people are feeling with what Trump has done that the world is ending. And that's the way the market was looking at that point. The market was down about 15% in less than a week by April the 9th. And he said, what he's learned in the past is you can't really predict the end of the world. You have no idea what to do if the world ends. The things that you might do for the end of the world is going to be disastrous if it doesn't end. And in fact, most of the time, the world doesn't end. Now, that sounds like a bit of black humor, but it does give one a little bit of perspective and hope when you need it most. In the same article, he made the point that the tariffs were there for good reasons. And I'm not going to go into any of these things, but if you look at all those bullet points, each of them has been stated separately or in combination as the reason for the tariffs. And if you look at all those points, they are good points. They are positive points. They are things that you should be able to ascribe to. The problem, however, and I'm not quoting any further from the article, is he says a lot of these things interact with each other and there's lots of unintended consequences. So you might have all these objectives in mind, but in the real world, it doesn't always work out like that once you actually implement the tariffs. And that's what we saw in the market in terms of all the uncertainty and market weakness. It's a great article. It's quite a long piece, but a month later, it's even better reading than it was when he published it on the 9th of April. Around the same time, I came across this tweet from Peter Maluk. It's somebody that I follow. He's a financial advisor in Kansas City. And it certainly gave me perspective. I forwarded it to some of my colleagues. And he said that bad investors sell in markets like this. And I think with your wealth managers at both Anchor and Credo, that's not what we would do. I think at worst, we will qualify for the second line, that, we aim to be good investors that might get nervous because we're also human, but we will hold through the noise. The best investors are those that are completely unfazed and those who see opportunities. And of course, some will be able to do that better than others. But at the very least, you expect your wealth manager, even though he or she may be nervous, to hold on and not to sell at exactly the wrong time. And I'm pleased to say that that's what we managed to do, and our clients have benefited from that since. In fact, if you look at this graph, this is just my personal favorite share in history. Microsoft, this is just the last 6 months performance. This was the share price at 431 on Thursday last week when I had to find out this presentation. Last night it closed slightly higher at 436. And if you look at the 6-month performance, it had its bottom on 7-8 April, a few days after Liberation Day, at $354. And on that day, this very day where it was trading $354, I was interviewed by Stephen Grootes on the Money Show in South Africa. And in fact, the recording is on our website for those of you who want to go and listen to it. And Stephen asked me the question. He said, so what's the perspective on markets? How much further can they go down? Because those protagonists who've caused this crisis are still in charge and will be in charge for some time. And my answer to him was that nobody can see the future and nobody knows exactly where it might bottom. I said to him, but let me put it to you this way. And I gave him the example of Microsoft. I said to him, Stephen, if you and I spoke in December when Microsoft peaked at $454, exactly $100 where it was trading on the 8th of March or the 8th of April this year, I said, we owned it then and we liked it then. I said, if you liked Microsoft at 454 in December, you should love it at 354 in April. And I'm thankful to say that, only less than a month later, or just about a month later, 4 weeks later, it's back up to the 430s. And of course, I had no foresight to know that it was going to recover so quickly. But it's simply a question of focusing on the fact that you own quality companies that you got at a reasonable price. And as I said to Stephen Grootes, I said to him, in 5 years' time, Microsoft will have a bigger business, a better business, probably make double the profits compared to what they're making today. And ultimately, the share price will catch up to it again. And one more thing, Microsoft and companies like that will all outlive Donald Trump. And that's the perspective that I think one should have when you go through these mini crises. It was John Maynard Keynes who wrote nearly 100 years ago of the animal spirits that ultimately drive markets forward. And that essentially has explained a lot of the wealth and the well-being that's been created through the principle of free markets and capitalism over the last century and more. And this is true even when a pandemic hit, or a fool gets into political power, or one of the biggest cities in the US happens to burn down. And ladies and gentlemen, we see it manifesting every time that an entrepreneur starts a business and makes our lives so much better than what we could have imagined before. By investing in equities, we get all these super smart, ever optimistic, single-mindedly focused individuals with their ideas and their energy and their management skills working for us while we sleep. And I think that's a perspective one should have when you are invested in a portfolio of equities. I love this tweet and this chart by Morgan Housel, who wrote The Psychology of Money, a book that I'm sure a lot of people on the call would have read, where he focuses on the performance of the American market over 150 years. And where he says that each page of his next book might just be called Shut Up and Wait. And look at that relentless march thanks to these principles of free markets and animal spirits. In hindsight, every all-time high, a buying opportunity, and every crash or correction, merely a blip. And one more thing, ladies and gentlemen, you should note the scale. This is a log scale. If this was a simple linear scale, then that green line would literally go to the roof of the building where you're sitting today watching this presentation. Coming back to the market in the last month, in the end, no doubt you've heard a lot about it. I'm not a bond expert, but Nolan will speak later today. And Nolan is definitely a lot smarter than me because as a bond guy, the bond market always calls the shots. I'm a simple equities guy, but if you look at what the 10-year yield did in the States going back to January, depending on the scale, the 10-year yield in the States came down by nearly 100 basis points at its best between the 20th of January and the end of March. And then, of course, when the market started realizing that Trump seemed serious about tariffs and didn't know exactly how to deal with it, it blew out by more than 40 points in essentially a day or two. That's the area that is gray. And that's also exactly the same time that Donald Trump started to walk back his tariffs, started to saying that it's got to be paused. And the next date that we should all be focusing on, if you haven't got it in your calendar yet, is the 8th of July, because that's when the 3-month pause will come to an end and where we will know whether it's paused again, maybe relinquished, or maybe even toughened. Time will tell. And I saw this little cartoon the other day that sums it up. The blue highlight there is what we've just lived through. And of course, it was at the bottom of the market on the 8th of April that the president decided it was his plan all along to start reversing course. And we saw the effect that had on the market. As I say on this graph in the headline, what a year April has been. Peter has made the point as well. At its worst, the market was down nearly 15%, and it's basically made back all of that by the end of the month again. The market is higher than where this graph ended. So essentially, as Peter said, if you went to sleep, not much seems to have happened, but it's been an extremely volatile period and one where it was tough to keep your head, perhaps, but the best thing you could have done, well, the best thing you could have done was to go into it underweight and to sort of add to your portfolio at the bottom if you have cash. But certainly the second best thing you could have done was just to ignore the noise and perhaps do nothing if you were fully invested in the first place. Ultimately, just one slide. This is not a marketing presentation for Credo product, but just a snapshot of our portfolio. Perhaps in future presentations, we will focus a little bit more on the way that we invest at Credo. We've got a value-based philosophy, and it's reflected in some of the holdings there. You'll see, for example, in our top 10, you'll see only one of the Magnificent Seven today, which is Microsoft. There are one or two others that we do hold, but they're not quite in the top 10. So it's a slightly different portfolio to a lot of other managers who don't have the same value bias. And it's certainly a philosophy which has stood us in good stead. I'm told by my friendly colleagues in compliance that I'm not allowed to show you numbers when it comes to specific performance because it comes with lots of hurdles in terms of making sure everything is signed off. But suffice it to say that we've had a pretty good period and we are essentially first quartile over most periods. But as I say, for more detail, you would have to consult our fact sheets, which are on the internet. Just one final slide about our investment philosophy. Peter has spoken about the rating in shares, and you can see how the ratings have evolved in the last few months, with the World Growth Index coming down a lot. This is not quite up to date. This is a couple of weeks out. So all those lines have blipped up slightly, but the broad trend is still indicative of what we've seen in the market over the last few months. So you've seen the pressure under which growth shares have been, and the Magnificent Seven leading that, whereas value shares have also been down, but not as much. And this is essentially what has benefited us, certainly up until the recent bottom of the markets. And now with the recent bounce in the market, clearly it started going slightly in the other way again. But ultimately, our philosophy complements that of Anchor. Is not exactly the same, but I would argue there's probably room for both in the portfolio for some diversification benefit. And ladies and gentlemen, for my final slide, the presentation is not a presentation if you don't quote Warren Buffett, and especially so now that he's decided he's got enough money to retire at the age of nearly 95. This is an old quote by Warren Buffett. He said this more than a decade ago. He says he can't predict what stocks will do in the short term, but businesses will do well over time. And then he looks at the last century, and he talks about the performance which has been up and down. In spite of 2 world wars, a Great Depression, flu epidemics, American businesses will always do fine over time. And ultimately, I think that remains the case. Doesn't matter who the president is. As I said before, Microsoft will outlive Donald Trump, as will the rest of the Magnificent Seven, as will practically every other company that forms part of US Inc. and ultimately the world. So I'm definitely not slashing my wrists or being bearish about the short term, even though I'm uncertain what will happen next on the 8th of July. We will always be long-term bullish and stick to our investment philosophy and focus on finding quality companies, not overpaying for them, diversify appropriately, and then managing through the noise. So I thank you for your time, and I will now hand over to Mike Gresty to talk about South African equities.
Thank you very much, Dion. Nice to hear you ending on a positive note there. I'm going to spend a little bit of time going through the how we're seeing things stacking up locally. Pete obviously gave a very high level view on that. And I think just to start off by repeating a couple of the points that Pete made, certainly if one looks at the high level performance of South African equities so far this year, we appear to have been one of the relative outperformers. However, we can really thank the gold sector entirely for that. If you look almost to around the middle of April, outside of the gold sector, which now accounts for about 15% of our market, which has literally doubled so far this year, pretty much every other sector was down. So, key message there is just the degree to which we've seen really, I guess, deflating expectations from the somewhat euphoric view that we had when suddenly everything seemed possible post the formation of the GNU last year. So as you can see from the title of my slide, it feels like we are, or presentation, I should say, we're back to the rather frustrating situation where we are investing once again in a relatively low growth environment. Fortunately, we have had a lot of experience of that. So, really what I want to spend the next number of minutes discussing is practically, let's be honest about where we are. We're in a difficult environment at the moment. I hope that we prove to be wrong, but it's important to go into this forearmed and with your portfolio properly aligned with that thinking. One of the great things, aside from the experience we've had with this in South Africa, is that, really our market is a combination of lots of idiosyncratic investment cases. And whatever we may say about growth in South Africa, there have been some fabulous success stories, and it's important to understand, where those lie. So that's what I'm going to be spending a bit of time in the next few minutes discussing. So just this is a rather sobering slide. This just looks at what's happened to South African growth in 5-yearly periods over the last 20 or so years. And you can see clearly that series of steps down. And particularly, I want to focus on the last decade where, South Africa has been growing at very suboptimal rates, below 2%. In fact, for the last 5 years, it's been barely 0.5% annual growth. That much more optimistic environment post-elections, people were talking about potential GDP growth in South Africa returning to 2.5% or so this year. And we were seeing steady upgrades in the latter part of last year. Sadly, that has gone into reverse. If you just look, it's not that clear on the scale, but we've seen in the space of just a few months, growth expectations for 2025 stepping down from close to 2% to, at the moment, I'm seeing numbers closer to 1.3. So that's a material downgrade. Not all of it is necessarily South Africa's fault. We're obviously living in a much more volatile environment. I don't need to tell you about that in terms of what's happening in the US. But certainly, the fractious state of the GNU, I like Pete's analogy about parents sticking together for the sake of the children. I think it certainly caused, be it consumers or corporates, when they're thinking about investing, purchasing, generally it's certainly not been supportive, but certainly the global environment much the same. So growth slowing, how do we invest? This slide, it's a little bit of a busy slide, but essentially, this is looking particularly at the last 10 years of what's been in aggregate a very frustrating, grinding South African equity market. And as I've entitled it here, at risk of stating the obvious, if one steps back and looks at companies that have been able to grow their earnings through this period of difficulty versus those that haven't, the top 3 companies there, Vodacom, Coronation, Sasol, a couple of examples of companies, many of them well-liked, that have really struggled in the last decade to grow their earnings. And no surprise, the share has followed suit. A couple of more successful stories, Clicks, Advotech, Afrimat. The important message to take away there is that these companies growing their earnings, even if you get your timing slightly wrong, you buy them at ratings that are perhaps, with the benefit of hindsight, a little bit inflated. What these charts show you is that time is your friend, and that compounding of earnings growth eventually gets you into a position where the share performs. And each of those shares, in a period when the aggregate market has not done much, have been multi-baggers. So, this would be an easy game if we could identify those companies that through thick and thin are going to deliver you solid earnings growth. So knowing that the wind is probably not going to be at our backs for the next while, the bar rises really high in terms of ensuring that you have absolute conviction about the investments that you hold and their ability to deliver you earnings growth, irrespective of what we see in terms of the macro picture. So, when we think back over the last decade or so, where have been the pockets in South Africa that we think you can really look for proper growth stories independent of what the macro picture looks like? And I guess the golden thread running through all of these examples of pockets of opportunity really comes down to something aligned with our investment philosophy, which is identify quality. High return compounders, good quality management, strong balance sheets, and what have you. But these are a couple of areas. So we're looking for businesses that are serial acquirers, but successful acquirers. Where there are companies that even in a slow growth macro economy uniquely have opportunity to expand. So we call that white space. Obviously, we have been living with public sector unable to provide services. And obviously that provides opportunity for companies that are able to capitalize on that. Self-help, I would caution that companies promising that, one has to apply a very high bar. When the wind is not at your back, often companies promising this are unable to deliver it. So just keep that in mind. However, it's a very profitable area of opportunity if you can get it right. Generally, South African companies have not been investing. There are, however, a couple that have been, and now are beginning to reap the rewards of creating those platforms, and we'll talk to a few of those. And again, many South African companies have tried to go offshore. Few have succeeded, but where they have, obviously benefiting from growth opportunities much broader than just South Africa. And then finally, you might call them the kind of cockroaches of the South African market. Maybe that's a bit unfair, but they're companies that are absolutely dominant in their places, in their spaces, run by strong management, and are simply gaining market share at the expense of the rest, which enables them to grow even if their spaces are not growing particularly quickly. So, that's all great. All sounds like motherhood and apple pie. But what are the actual companies that represent some of these opportunities? I'm just going to run quickly through a few of those. So where do we see clear domestic expansion potential? No surprises. Here are a couple of companies that are quite new listings in South Africa. And I suppose at a more macro level, that's been a rather unfortunate thing about South Africa. Our market is pretty stale, and there are not many of these, but it's nice to have We Buy Cars and Boxer join our market in the last year or so. So We Buy Cars is really emerging player in the second-hand vehicle market. And despite having delivered really strong growth over quite an extended period now, it still represents less than 10% of the second-hand vehicle market and is rapidly expanding its geographic presence. There's lots of interesting ideas as to how it's going to persuade you to turn your car over more frequently, but certainly a very strong management team executing well with lots of white space. Boxer obviously spun out of struggling Pick n Pay last year. It started life as a food retailer in KwaZulu-Natal. And no surprise, as you can see, just the geographic footprint is obviously highly concentrated in KZN. So really that leaves the rest of South Africa now as real white space for it to continue to expand. So there's a couple of ideas of, not only strong, clear growth stories, but very good jockeys driving the business and delivering on it, where we can see evidence of that historically. Successful acquirers, we've picked CA Sales here, CANS, probably not a company that's particularly well known. It's a company, however, that also has established a very strong track record. It's aiming to take its turnover from around 12.5 billion last year to around 20 billion by 2026. Essentially what this business does, it's a logistics and merchandiser for global brands more outside of South Africa, very strong in Botswana, but sort of sub-Saharan Africa. Recently, it's acquired Roots, which has given it a presence in the informal market in South Africa. And then literally in the last number of months, a company called Tradeco, which now opens up the whole of East Africa for it to provide very similar services. So, business growing strongly, has had a good track record, and is a slightly different one. Hideko, again, perhaps not a particularly well-known business, but with a long and much, very impressive track record as a serial acquirer. It's essentially almost a platform business that has a well-honed acquisition strategy, adding branded, imported consumer and industrial businesses where it imports parts and then supports them in South Africa. What's rare about this business is that it, despite having been very active on the acquisition front, has managed to maintain a return on equity of almost 20%. So that really tells you that this is a business that's quite selective in what it buys. It doesn't buy turnaround businesses. It tends to pay sort of 4 to 6 times multiple for successful businesses. It itself trades on sort of 8 to 9 times earnings, and essentially optimizes those businesses, enables them to benefit from its platform, and essentially recycles capital into further acquisitions. So as much as you might see this as a very direct reflection of the South African macro picture, its acquisitive strategy has enabled it to significantly outgrow what you would expect from a relatively slow-growing domestic economy. If we talk about capitalizing on public sector weakness, I think one doesn't have to go further than the education space in South Africa. That graphic on the left-hand side there just shows you a rather terrifying picture of the number of applicants for positions at each of the public sector universities in South Africa versus the number of places available. Now, I'm sure there's a lot of duplication in terms of applications. There's probably a lot who stand no hope in terms of their academic record of getting in, but it's a very graphic picture of just how big the demand is for tertiary education versus what's available. And particularly Stadio is really capitalizing on this opportunity. Advotech is a more diversified player, strong in tertiary, but adding to that its education business, at a school level, both in South Africa and in the rest of Africa. But you can see really that, strong compound earnings growth in a space where we certainly have good conviction that the opportunity is not going away. If we look at self-help opportunities, I made the point that the bar has to be very high here, given how difficult this is if you don't have the right team driving it in such a difficult environment. Hence, we've only got one example that we feel particularly confident in. Tiger Brands has been a serial underperformer over the last couple of years, and we've seen Chart Kruger join. He joined as CEO in late 2023. Prior to that, he had a decade at Premier and obviously really demonstrated his strength there. And he's come in with an aggressive turnaround story that we're seeing being implemented in Tiger Brands. Not only are they simplifying the business, getting rid of underperforming non-core parts, rationalizing the number of brands they represent. A hugely important part of this business is turning around the highly competitive milling and baking division. We've seen profit margins under massive pressure. He's reinvesting in their bakeries. They're building a super bakery in Pretoria, which will materially improve the competitiveness of this business. And certainly an indicator of his confidence, we're seeing him buying shares on a regular basis over the last number of months. So this looks like an interesting self-help turnaround that we are certainly willing to back over the next couple of years. In case of the rare situations where companies have invested meaningfully in South Africa, and now we're starting to see them reaping the benefits of that, Discovery has certainly at times been criticized by investors for probably biting off more than they can chew in the early 2020s in terms of the amount that they were spending on new initiatives. Discovery Bank, which was heavily loss-making and absorbing a lot of investment. Their Vitality Global strategy, which also at times struggled, was really chewing on profitability and cash. Now you're starting to see them come out the other side of that investment hump and the J-curving of profitability, which is set to unfold over the next couple of years. So quite a rare growth story within the financial sector. And then Afrimat, which not only has been quite an acquisitive business, but has been investing heavily behind those acquisitions and you're starting to see that inflecting out, and we should be seeing much better growth. Obviously, the market looking very closely at their recent acquisition of Lafarge. So we're going to see probably very poor results from Afrimat in the next week or so. But the outlook beyond, what's been a tough year, admittedly, for them with their past investment and recent acquisition, which they are rapidly turning around, puts Afrimat on a very strong growth path from here. Strong team, which we've certainly backed for quite some years now. Looking outside of South Africa, I mentioned that it's been a rarefied space in terms of companies that have genuinely succeeded and become proper global businesses. Bidcorp would be an example of that. What this chart on the left reflects is the degree to which the mix of business has really favored in recent years the growth of its developed market business. So that's really your British and European and Australasian operations. What Bidcorp is really focusing on now, after extensive investment in capacity, is moving into much more bespoke, high margin food services instead of sort of stack it high and sell it cheap, and really beginning to differentiate itself, supplying restaurants with higher margin produce that is unique to Bidcorp. Then, I'm sure in terms of people talking stocks, a regular share that people tend to talk about would be Prosus. It's had its ups and downs, but obviously, Tencent, after a really difficult period in the early 2020s, we're seeing, the Chinese government now much more supportive. That wasn't always the case, and I think the situation it's facing with the US is certainly putting more pressure on China to be more supportive of its domestic corporates, particularly champions like Tencent. And we've seen certainly much more evidence of it beginning to compound earnings nicely in a more permissive environment, and importantly, a greater focus on profitability. So that looks good. But alongside that, within Prosus, you've got the benefit of I think a much more focused strategy around the rest of the investment portfolio, essentially building self-reinforcing tech franchises in Latin America and Europe, and a focus on profitability, and finally rounded off by share buybacks. We think all of that adds up to quite an interesting compounding growth story over the next couple of years. And then just finally, in terms of market share gainers, these are going to be perhaps no surprises to you. Shoprite has been an absolute juggernaut within food retail. And despite the size of this business relative to the competition, you see it continue to gain market share. One of the interesting stats is that it's literally investing more in terms of its platform and tech and you name it than the entire market cap of Pick n Pay, which I think just gives you sort of comfort as to the domination that this business has. Very high return on capital. Capitec, obviously well-known compounder, has absolutely astounded us in terms of the market share it's been able to garner within retail. We're now seeing it at the very early innings of starting to grow in business banking and commercial and corporate. And, essentially it's not necessarily going to be as easy. The rest of the banks are not going to give it up to Capitec easily, but certainly this is a business that has continued to demonstrate its ability to take market share and comes at it from a position of great strength. Just in conclusion then, a couple of things that our recent experience has suggested that we should be very careful to avoid. When times are tough, I would say that in aggregate, your bar for taking risk rises substantially. And a few things we would be very careful to avoid. We've had a number of situations where we've been very confident in corporate action happening, and it simply hasn't. And I think we've acknowledged that this is an environment where, be it from a regulatory approval perspective or just confidence to do deals, these are proving much more difficult to get done. So to be approached with a high degree of skepticism. Be particularly careful of companies facing refinancing decisions. I think Murray & Roberts is a great example of a business where it appeared it was on track to roll over its debt. The next thing, it's in business rescue, and essentially shareholders have been wiped out there. So be very careful of balance sheet at the moment. Companies that are stumbling, do not back underdogs. This is not the environment for that. be confident in management, make sure that there's a decent track record. And, you know, as I say, be careful of business turnarounds. Dion, just echoing your points that no presentation exists without a quote from Warren Buffett. So we'll back you up on that one. And this is one that I particularly like. And it's just a reminder that where you see stumbles, very often there turn out to be more problems than you realize. So, you know, be hard on whether you're prepared to stick with underperformers. So just in conclusion then, you know, the key message here is, I guess, from an SA equity perspective, one of caution, wash, rinse, repeat of what we've been going through for the last decade. You know, that can be frustrating, but I hope the message that I've delivered is there are many idiosyncratic opportunities that remain here, very good management teams with work. This is a stock pickers market, and there remain great opportunities. But, you know, we acknowledge that the range of potential outcomes, given how complicated the environment is at the moment, is very high, and we've adopted a fairly cautious stance with a downgrade to a neutral allocation to South African equities. And with that, I'm going to turn over to Nolan, the smart guy in the room, to take us through fixed income.
Thank you very much, Mike, and you flatter me. Hello, everybody. I'm Nolan Wapner. I've been introduced a few times today. My role is that I'm Co-Chief Investment Officer at Anchor Capital. Really, I'm head of fixed income in terms of day-to-day role. So I'm all about bonds. I'm all about everything that pays interest income to investors. And I'm going to talk you through the opportunities as we see them. You will have noticed on our asset allocation, we actually think that bonds can actually return 11%, sort of in line with equities in the near term. And that's actually a reasonably sort of consistent view we have in South Africa. So there's definitely some merit in fixed income in your portfolios. As I sit here, typically, I've been presenting it where the money will be made for a number of quarters now. And there's a sort of theme that runs through my presentation. So a lot of the images are those of, you know, in line with our nautical sort of theme of yachts parked in bays, wind in the sails, you know, very calm sailing. In terms of this presentation, I've had to change the images a bit. I've needed something that shows more what we've been through over the last month or over the last 100 days. And what I'm trying to convey here is that, as has been said, if you took your statement at the end of last month, you took your statement previous month, you took your statement at the end of April, you'd see that actually your investments have performed reasonably well. They've done in line with expectation returns. And in some cases, actually, some of our portfolios have performed particularly well. So it's actually been a decent month for investors. But underlying that, it's actually been quite a financial storm that we've been through, and we've you know, acquitted ourselves well sailing through the storm, but it certainly has had its challenges. And on the left-hand side, I talk about you know, some of the issues that we've dealt with over the last month as this has unfolded. Now, I'm here today to say that, you know, the storm isn't over. Yes, our valuations, our investments are kind of back where they were, but the storm is still going on, potentially at lower intensity. And what do I mean by that? Well, I mean, we still have tariffs. And as Dion said, you know, circle the date that the, you know, temporary suspension runs out, and let's see how many trade deals have actually been done. We do think that you know, there's some volatility from that. Look at the tariffs. Many of the tariffs have been implemented. We can talk about the 10% base tariff that does exist today. Tariffs on you know, Canada and Mexico, for example. We still got those. We do have a significant blockage to trade between the US and China. Now, that's almost one of the world's sort of largest manufacturing hubs and one of the world's largest consumer hubs. That trade blockage is going to continue to be problematic. And yes, we've got some exemptions that we're living on, but by and large, it's going to be quite fractious for the next while. We do have distrust that's been generated through the tariffs. A lot of America's trade partners are acting with a bit of surprise, with a bit of shock. You've got consumers in a number of countries saying they prefer to avoid American products at the moment. This is all putting further pressure on the system. You've got questions and distrust from financial markets. I think financial markets, we've been living by tweet over the last while, policy by tweet, which makes investors skittish. It raises the bar for investments, as Mike Resty so beautifully said. And really, you've also then got the labor markets. I think the US has been very actively deporting people, very actively making it difficult for people to come into the economy. Now realize that the people who they're sort of pushing out, a lot of them are actually the people who are taking the low-paid jobs, the jobs that Americans don't really want. So the labor market was nicely in balance, but there are questions as to how this plays out in future. So you've got all of these questions sort of compounding themselves, and we're sitting here saying, what does this mean? Now, I don't know what this means. I think we're all watching to see how it unfolds, but it is true to say there are some trends that are beginning to develop. There are certain narratives that are likely to persist. And we're looking at these narratives and saying, how do they influence our investment patterns here right now? And how do they influence our investment patterns within fixed income? So let's look at some of these investment trends. And the first trend I want to talk about is the US dollar. So if you look over the last decade, the US dollar has actually been a little bit overvalued. It's been about 15–20% stronger than fundamentals would suggest. Now, there are good reasons for this. The US has been a haven of safety. So every time, we've felt a COVID surprise or something else, people have flocked to the dollar for safety. At the same time, the US economy has been an absolutely phenomenal place to invest. You've seen spectacular returns out of the US economy in terms of equities. That of itself is also, supported the dollar. But there are questions around both of those aspects right now. And as people start to question that, you sort of see a little bit of this shine, this sort of overvaluedness of the dollar just retrace itself. If the dollar goes from just being overvalued to fair value, so I'm not talking about undervalued, I'm just saying let's go back to where fair value is. Where do fundamentals suggest the dollar should be? Most analysts are saying that's somewhere around the 120 to 125 to the euro. So quite potentially the dollar has a further 5% weakness, which will unfold over time. As an investor, what does that mean for me? Well, the US with a stronger dollar, with a dollar that's weakening, is going to see inflation pressures come through that, coupled with inflation pressures from tariffs, etc. For the next decade, it is very likely that US inflation is higher than it was for the previous decade. Conversely, if we look across to the Europeans and even South Africa, a weakening dollar equals a stronger rand, stronger euro. That becomes sort of deflationary for us. In South Africa, we talk about our inflation at 2.7%, lower cost of fuel, lower imports, yes, lower oil price, but also slightly stronger rand. At the same time, these Chinese goods that are being manufactured need to find other homes, and they're probably going to be deflationary in the rest of the world. So you've got this sort of subtle shift that's taking place, where in the US, it is going to be slightly higher inflation and the rest of the world will probably benefit from slightly lower inflation. In time, we actually see it being easier to cut rates in the rest of the world. We think that European bonds, South African bonds, etc., have a higher propensity for capital gains. And if you just want to earn steady state income, actually US bonds will give you far more consistent interest yields going forward. Looking at US bonds, and there was a chart up earlier from Dion, which showed that Donald Trump showed that there is a point where he blinks. There's a point where he got uncomfortable, and that was the point at which the bond market suddenly began to wobble. And that is a message that's been received by the rest of the world. So the world is looking at that and saying, at the negotiating table, we need to talk about our bond holdings. Japan actually openly said that today for the first time. So increasingly, we think that there will be a weaponization of bonds, of people holding US bonds. And you've got a pie chart there showing who the key holders are. The big numbers are the Japanese with just over $1 trillion of bonds and the Chinese with just under $1 trillion of bonds. This negotiation, which is going to take place, is now going to include discussions of bonds, bond holdings. It's again going to be an environment where they're going to talk bond yields higher. We expect a more cautious approach from investors in US bonds going forwards. So from that perspective, it's something just to be aware of. Looking at the key trends, the whole idea, or one of the ideas behind tariffs, was that companies would move their manufacturing onshore it back to America. But to do that, what you need to do is invest in factories. What we've got here is a chart which shows you the sort of growth rate in factories and investment in industrial robots. So if you look at India, what that's saying is they bought 20 or 59% more industrial robots last year than they did the previous year. Their industrialization is accelerating. They're investing more and more and more in manufacturing capacity. On the left-hand side, you've got countries that are investing less and less and less in manufacturing capacity. And actually, by and large, with the exception of Taiwan at the bottom, that's because they are becoming more consumer-led, they're becoming more service-oriented, which, to be honest, is something China's been pursuing for a long time. So from that perspective, that raises some questions. The US is gradually deindustrializing, and if it's doing that, we're in a situation where it doesn't have the factories and it doesn't have the manufacturing capabilities to produce these goods. It's going to take a long time to invest, and right now, with all of this uncertainty, few companies are really investing in major expansion of plants. From that perspective, we are talking about more inefficient manufacturing. We're talking about more inefficient goods in the US, again, potentially raising long-term inflation rates. So we are thinking, again, higher inflation in the US, and these goods that are being produced in the rest of the world will be finding their destinations in Africa, in Europe, bringing inflation down in those regions. Finally, the world has benefited over the last decade from globalization, from global trade. We've seen a significant economic growth across the globe because of it. Clearly, deglobalization means that economic growth will slow down. So looking at the next decade, we also think that there is going to be slower economic growth than you saw in the previous decade. We're adjusting for that. I think that again says to us that bond yields generally will be a little bit lower to allow for that, with the exception of countries that potentially are seeing pressure on their borrowing levels, or seeing significant debt levels, and in those countries you're going to see yields a little bit higher. But by and large, what am I really saying? I'm saying that most of the world is going to see this as being a reasonably positive bond environment once the dust settles. I think the US bond yields are going to be a little bit higher than we've seen over the last decade, but nonetheless, good investment opportunities. So to sum this all up, what are we saying about global fixed income? We're saying that, looking particularly at the US, we do think that there are 2 interest rate cuts in 2025, but they're going to be back-ended. And there are some questions as to, the levels of debt in the US, the levels of trust. So you don't want to own 30-year bonds. There are questions on the direction of the US right now. And what you'd rather own is shorter data bonds, sort of bonds with a 5-year maturity, maybe a 3-year maturity. That will give you a lovely core element of stability, but at the same time, lock in attractive yields. Anchor Global High Yield Fund is the way to go there. We're showing 5.5% net return to investors, and the bonds are pretty short dated. Turning our attention to South Africa, it really is about the government and national unity. The bond market has made no secret of the fact that the bond market likes the government and national unity. We want to see it persist. And if there's any talk of the fragmentation of the government and national unity, the bond market in South Africa has a heart attack. It really feels it quite severely. So from that perspective, we want to see the GNU succeed. Thing is that, as we sit here, we're about a year away from municipal elections. And next year, all of the members of the GNU are actually going to be campaigning against each other for municipal seats. So we think that the strain on the GNU is going to keep increasing. At the same time, we've been through, budget version 1, which almost was a non-starter, budget version 2, which really tested the GNU, watching for budget 3 in a couple of days' time. But putting all of that together, what has been learned is that the ANC can't just dictate policy anymore. It's going to have to work with other parties. It's going to be uncomfortable at times. It's going to be more fractious. We've actually seen the NHI bill. I got a text a few seconds ago saying that that's probably going to be questioned in court now. On top of that, we've got the employment equity amendments that are going to court. So increasingly, we're going to see sort of infighting within the GNU. Likely it holds. I think it's, however, going to be more and more fractious. Back in 6 months ago, we were talking about potential economic growth of 2% in South Africa. That's dropped. I think Anchor is now talking about 1% economic growth. I know, the national budget will probably put in sort of 1.3, 1.5%. But this slowing growth is going to keep us under pressure. It's going to see our fundamentals deteriorate because our debt levels keep going up and our economy just isn't growing at the same pace. It's not keeping up with the sort of growth in debt. That is what worries us, and we need to see that come under control. So what does that all mean? Well, domestic income, we've seen inflation in South Africa at 2.7%. That is going to give the Reserve Bank a good reason to cut interest rates at the end of this month. And we think that there'll be a further cut in June, July. That's two further interest rate cuts. That takes the prime rate to 10.5%. At that point in time, we think it becomes more difficult for interest rates to be cut. It's not impossible that we get a third, but I wouldn't bank on it. And from that perspective, we think, that interest rates are going to remain reasonably high in South Africa. And why are they high? They're high because our fundamentals have stagnated. How do you position for this? You hold the core income fund. You're going to earn CPI plus 5% to CPI plus 6% on very low risk investments, very attractive for most people. And then for a little bit of extra benefit, you just blend in the flexible income fund. Finally, just looking at the Rand, South Africa, Anchor subscribes to the purchasing power parity model, where you can see the Rand depreciate over long periods of time by the inflation differential between us and the US. I've also spoken about the US dollar potentially giving up some of its strength. That'll benefit the Rand. At the same time, terms of trade have swung massively in South Africa's favor. And you've got gold prices that are up, oil prices that are down, positive trade surplus of 24 billion, the highest in the last 3 years coming through. That is also going to benefit the Rand. And really the only factor holding us back is going to be politics. As this sort of works its way through the mix, we think that there is propensity for the Rand to recover some of its lost ground. We think it'll strengthen a little bit, but I stress the words a little bit. So at the time we wrote Navigator, I was talking about sort of 1875. I think the Rand's well through that right now. And, as assuming that the gold price holds up, it's very plausible to start seeing the Rand trade back in the high 17s. So that's how we're thinking about the Rand right now, with the sort of gradual gains while we're in a wait and see mode to see where the politicians take us. But with that, I'm going to stop here and I'll be back for questions and answers. I'm going to hand over to James Bennett just to take us through his presentation. Thank you.
Thank you very much, Nolan. Good, right. Good afternoon, everybody. It's James Bennett here. For those that haven't heard me present before, I'm a global equity analyst at Anchor. I've been in the market about 30 years now. A big part of the earlier part of my career was actually a sell-side analyst covering South African but global mining shares. And what I'm really just going through in this presentation here is that if you are somebody who's never invested globally before, or maybe you've only recently started investing in global shares, here's some of the things that I've picked up over the years after initially, obviously, only investing in South Africa, and then, in time, more pivoting to global stocks as well. And these are kind of the things that I wish somebody had taken me for a cup of coffee many years ago and saved me a whole lot of time and maybe explain some of these things to me. So what I'm not going to be talking about today is the topics you see on the slide here. Is passive investing damaging the market? Is the US market too concentrated? These are all very valid topics, but I'll leave that for somebody else to discuss on another day. I think one of the biggest things that I've actually tilted over time is many years ago, especially covering mining stocks, probably my number one factor was valuations. So I was, everything reverted to the mean. Quality was still important, but it was maybe, less of a factor for me. Whereas what I would say is that looking more at global stocks, I've probably tilted more towards quality and then putting valuation second. Now, you'll notice that I haven't discarded valuation entirely. It's just that I probably focus more now on quality than I used to in the past. And I think if you make a good stock call and you invest in something for many years, you'll probably look back and say that it probably had very little to do with that spreadsheet of mine 5 or 10 years ago when I bought the stock. But most importantly, I actually got the quality of the business right. And I always like to sort of say, that tongue in cheek, many years ago in South Africa, it felt like we kind of bought companies on 10 PEs. We started to get nervous when they hit 15 PEs. And then when they hit 20 PEs, we sold and asked questions later. Whereas it feels like if you're going to invest in some of these really global champions, the stocks almost start at 20 Ps and work their way up from there. So I think I've become a lot more careful about just discarding a company as an investment idea based on the so-called optic valuations. In other words, just because something looks optically expensive, maybe a 30 or 40 PE 1 year forward, doesn't mean that the company's uninvestable, and you can still make a very good, return over time. Here's somebody that I really like to follow. Is a guy called Aswath Damodaran, and he's the finance professor at NYU School of Business, and also known as the Dean of Valuation. Now, there's probably very few people in the world who know how to value companies better than this guy. He's got many thousands of lines of spreadsheets. And the reason why I give him as the example is you'd think a guy like this would just be numbers, numbers, numbers. And what he always says is that even for him, numbers is only half of the story. And it's very important to understand the narrative or the bounded storytelling. And as he has frequently said, if you limit yourself to rigidly only buying global companies that are under a 20 PE, you're going to really limit yourself from having owned some of the really great businesses over the last 10 to 20 years. There's something that's called the Lindy effect. And what this says is that the longer that a company or an object, a non-perishable object, has been in existence historically, the longer it's likely to remain in existence going forward. Now, this doesn't always apply, but it's a very good rule of thumb. So take a company like Hermes that has been in existence for over 180 years. I mean, here's a company that's been through 2 world wars, the global financial crisis, the Great Depression, through COVID. If it survived through all of that, the chances that a business like that is going to go bust in the next 5 years is extremely limited. So, again, as we say, it's not just a simple case, of buying a portfolio of old companies, but there certainly is some value that one can put to these very long dated companies. And the point is that for the most part in South Africa, we just don't have access to these kinds of companies. And the other point is that companies that have been around for this long with this kind of history typically don't trade on 5 PEs, and you sort of have to, pay up for them. I mean, my history as a mining analyst, I had many tens of thousands of lines of spreadsheets. And even to this day, there's nothing I love more than a good spreadsheet. But there's no doubt that especially with these global secular growth type of companies, that you're just not going to find all your answers on a spreadsheet. And there's this great quote, and I put the source there as various because I don't think anybody knows who originally came up with this. I think I can throw in Warren Buffett and Charlie Munger as amongst others who've probably quoted this in various forms and shapes. And all it says is that if the answers to investing could be found on a spreadsheet, all the world's Excel junkies would be the richest people on earth. And obviously, we know that that's simply not the case. So I think I've just become a lot more open-minded about optic valuations. I don't just simply discard a company as an investment idea just because it's trading at over a 20 PE. Here's a really good example in history of a business or an acquisition that Alphabet or Google, as some might know today, bought YouTube back in 2006. And optically, it looked incredibly expensive. So they paid about 10 times revenue. So that's not earnings, but revenue for a business that was actually loss-making at time. And with the wonderful benefit of hindsight now, we can fast forward to 2024. And had we really known where the future for this business would be, they hadn't actually paid 10 times revenue, but 0.05 times forward revenue. Now, just to balance this, bearing in mind that Alphabet have made over about 250 acquisitions over this time, many of which have either partly or completely failed. So it doesn't always work like that. But especially in the world of big global tech, one has to just be careful about simply saying, at face value that something is overvalued. Now, Dion mentioned earlier, Microsoft being his favorite global business of all time. I think mine is probably Fortinet. And here's a really good example of a company that optically has looked expensive for many years, but has actually ended up being a fantastic investment over time. So what this chart shows, the blue line is just the dollar share price of Fortinet. And then the orange line is the 1 year forward PE of Fortinet read off the right-hand scale. So this is one of the world's leading cybersecurity companies. It's the second biggest in the world in that space by revenue and the third biggest by market cap. And what you can see on that orange line is that this company has virtually never traded below a 30 times 1 year forward PE. In fact, it's varied between a 30 and 80 times. And I remember chatting to a lot of South African friends about this in 2016 and 17 and 18. And they all said, look, this is a great business. Thank you for explaining it to us. But, how can we ever pay a 30 or 40 PE for a business and expect to make a decent return over time? And over this period of time, it's grown about 20-fold. So again, that doesn't mean you can just run out and overpay for anything and everything. But there are examples of a lot of global companies that optically have appeared expensive for years, but have still been fantastic investments. And what I just show here again on Fortinet is the dark blue line is that 1 year forward PE. But with the wonderful benefit of hindsight, on the orange line, I've actually looked at where the share price was years ago, divided by the 5 year forward earnings. Now, had we known where that 5 year forward earnings was going to be, which obviously we didn't know at the time, we would have seen that actually the market would consistently put this company on a single digit 5 year forward PE. So again, the US market has got a very good feel for valuing these longer dated growth companies. That's not to say that some of them are not overvalued, but again, just keep an open mind about these optic valuations. Another example of a company that we also own in our portfolios at Anchor as well is a company called O'Reilly, which is the US's biggest auto spares manufacturer, probably joint number one with AutoZone. And again, here the blue line is the dollar share price over time. This share's gone up 100-fold since 2000. And the orange line is the 1 year forward PE, which is ranged anywhere between 15 and 30 times. And again, the point with this company is that it wasn't so important to time your entry from, to say, well, I want to only buy it at 15 or at 20 or even at 25 PE. The most important thing was just to understand the quality of this phenomenal business and just to be invested in it over time. One of the other things that we see in global companies that we don't have so much in South Africa, which sometimes optically makes them look very expensive, is the optionality that we see in these companies. Now, optionality doesn't just mean that you are a restaurant company that can own a whole bunch of extra stores. But what it means is that by virtue of your business and your installed client base, it puts you in a position to add completely new revenue lines over time. Now, in the case of Tesla, I just give this as one example. We can, the discussion for whether Tesla is a buy or sell is probably for another day. And this is a fairly small part of their business. It will never be the make or break of the investment case of Tesla. But what we can see is that from almost nowhere, this business on the side that nobody was really talking about has grown tenfold. And we see that with a lot of other big global companies as well. Another example, in this company we do also have in our portfolios at Anchor as well, Shopify. It's one of the world's leading e-commerce businesses. I mean, the optionality in this platform is absolutely phenomenal. And the new revenue lines that these guys have been able to incrementally add and bolt onto their platform over the years has been pretty significant. Again, it makes them more difficult to value. It makes them optically look expensive, but this is the kind of thing that we have in some of these global companies that arguably we don't have in South Africa. One of the other things that I've really learned with global investing as well is that you bet against the top dog at your peril. Now, again, these rules are there to be broken. It doesn't always work. But I think years ago, I would have, often said, well, I'm going to go for the number 5 or 6 play in an industry that has got 2% market share and is trading on a low PE multiple. But I think we've seen that, the bigger just get bigger and stronger. So, Netflix in audio in visual streaming, and Spotify in audio streaming, and Datadog in, global observability. These top companies with big market shares, even though they often trade on quite a bit higher multiples, have more often than not, from an investment perspective, actually been the right place to be. I think one of the other things that I've also learned, especially with big US tech companies, is that, years ago, I would have just said, well, the best tech sells itself and you don't really have to worry too much about marketing. But I've quite often seen where there's companies that maybe their tech, while it's very, very good, might not be absolutely the best in the market, but these guys will have a sales and marketing team second to none. And I think these days I put a much higher weighting on a strong marketing team than I might have done many years ago. I think the other thing about global investing, and nobody really knows the exact number, but there's probably something like 50,000, listed companies if you go into all the small companies in all the various markets. And it's extremely important with global investing to have a two hard camp. So even the red hot AI theme at the moment, there's many seasoned fund managers out there who are actually just putting it in the too hard camp, away from the obvious winners of Nvidia and the big hyperscalers in Amazon and Microsoft and Google. Even companies with big teams of analysts will put a whole lot of stuff into the too hard camp just because there's too many unknowns. The other thing I would say is that when you invest in global markets, just because there are so many listed companies and so many red hot ideas out there, that FOMO is a much bigger thing than it is investing in South Africa. In South Africa, it feels like everybody's mostly invested in the same companies. And even if you miss one or two here or there, the chances are they were just staring at you in plain sight anyway. Whereas when you invest in global markets, it feels like your friends are all investing in these hot shares that are doing a whole lot better than yours. And the point I'm making here with this graphic is just resist that temptation to throw darts at every hot idea that comes, whizzing past your ears. The other thing that, just to balance all of this as well, is that it wasn't just a simple case of buying Netflix and Google and Amazon 20 years ago. At the time, things were a lot less clearer than they are today. And there was a lot of roadkill along the way too. So here's just a short list of companies that back in the day looked like they were going to be the dominant players that we have in Amazon and Apple and Alphabet today, but ended up falling along the wayside. My final slide that I'm going to talk to is that I will say that I think bubbles are something that one has to be a little bit more careful in global markets than in South Africa. It feels to me like the last real bubble we had here was probably the tech bubble globally that infiltrated into South Africa in 99 and 2000. Since then, we really haven't had to have a look at this, whereas globally, individual stocks, subsectors, overall sectors, and even the overall market can be a little bit more susceptible here. So just one has to be very, very careful of those with global investing. And that wraps up my chat, and I'm going to hand back to Pete to wrap it up. Thanks, everyone.
Right, fantastic, folks. I think that was quite a lengthy, but hopefully very fruitful and instructive series of presentations. So we're not going to carry on with question time for too long, but hopefully that gives you a perspective of how we see things. There's certainly lots of attractive investment opportunities out there. I think where interest rates are, we can get nice inflation beating returns. I think both Dion and James have shown you in equity markets, certainly from my experience, our big clients who've got hundreds of millions of rands over generations a lot of them have made that money out of equity markets. I think there's a question about gold that's gone up, at a hell of a pace I think with uncertainty in the world and people feeling uncomfortable, it's been viewed as something of a safe haven, and the dollar hasn't acted like a safe haven. So what do we think of that? I can see it's always very difficult to put a value or price, and the participants are quite nervous that I'm going to throw it at them, but I see Dion has taken his mute off. So Dion, perhaps you give us your perspective of gold. I'm not actually sure how you feel about it.
Peter, thank you. If I'd known you're going to pass the question to me, I wouldn't have taken my mute off. I took it off. I was actually asked this question about 2 weeks ago by a friend of mine in South Africa who's in the industry, who wanted me to email some thoughts. And I went back and I said, you know, I'm probably the wrong person to ask the question. And the reason I said that is that I've had a bit of a structural view, personally speaking, and it's also been reflected in our positions at Credo in the time that I've been here, not only because of my own view, but my colleagues share most of it. We've not really been, you know, gold bucks, so to speak, you know, bulls on gold for the most part. And we don't own any gold. And of course, in hindsight, that, you know, could be considered a mistake because gold, of course, has done very well. And as I said, you know, I think that a large part of the run-up that we've seen in gold in the last few weeks and months has been ascribed to all the uncertainty and all the Trump noise. And ultimately, when this inevitably works itself out of the system, you know, I think we'll probably see some reversal. I will always focus on real businesses that make you money. That example that I mentioned, having all those captains of industry working for us while we sleep, because there I can see a clear path to future riches by backing those people and staying invested. Whereas with gold, you've ultimately got, you know, an unproductive asset which has amazing swings over time and for periods can outperform beautifully. But it's not really something I could identify with personally. But having said that, as I said, I'm maybe the wrong person to speak to. I'm sure there's opposing views around the table. I'll say one more thing, and that is that my view is partly informed. Once again, I'm going back to Warren Buffett. Around the time of the financial crisis or soon after, about 10, 12 years ago, in one of his investor newsletters, I think it was 2011, people can go and check this. At the time, this was just when gold had its previous big run, you will recall that. And he said that he spoke about the value of all the gold in the world, and he then equated it to, from memory, he said 10 Exxon Mobiles. It was the largest company of the world at the time after the financial crisis. All the farmland in the USA, plus something like $1 trillion. And I forget the exact number. Sorry, I didn't go and check on the quote, but you'll find it. You'll find the Exxon Mobil quote, the farmland in the US, and something like $1 trillion. He called it walking around money, pocket money. He says, that is the value of all the gold in the world. So if you ask me, would I rather have all the gold in the world, or would I have 10 times the biggest company that makes money and that will keep on paying you a dividend ad infinitum, plus all the farmland in the US, plus some pocket money? He'd rather have the latter. And ultimately, I would echo that.
Great, thanks, Dion. Nylan, perhaps to talk a little bit more about the US dollar. And that obviously has quite a lot of significance for South African investors when they're moving offshore. Do they go into the euro? I think the default has always been to go into the dollar. And, you know, if the dollar was to settle at 125, that's, you know, you would, if we knew that was going to happen, I think investment decisions would be quite different than if you took the view it was going back to 110. Now, if you look at the last 10 years, the extreme's been 125. The average has been about 109 for the dollar versus the euro. You know, I think you're suggesting a fair amount of further dollar weakening. You know, if the Trump sanity, you know, if there's a sane outcome to the whole tariff issues out there, and the world normalizes a bit more, and we get away from the chaos, you know, what are the scenarios, and how much emphasis would you place on each of them?
Sure. So what's been driving dollar weakness of you know, in the last month or so is you've obviously had that storm we've all spoken about in financial markets, and at that point in time you have a flight to safety. Traditionally, you've had a flight to safety into gold, but into the dollar, but that has been a little bit uncomfortable because it's actually the US that's causing all of these issues. It's not really a sort of natural safe haven. So instead, you've seen a bit of a flight into the Swiss franc, but the Swiss don't really want too much more money. You've seen a bit of a movement into the yen, and you've seen the movement into gold that Dion was just speaking about. And it's that seeking safety that's pushed the dollar weaker. as we sit here now, the question a lot of people are asking is, going forward, this is going to cause dislocations to US companies. Even if Trump comes out tomorrow and says, "Hey, it was all a big joke, changed my mind, don't worry, Xi Jinping has phoned me, we've made peace." It doesn't matter. I think the sort of capriciousness with which it was done has rattled investors and surprised people. And there's an unsettled element that's going to persist for a while. That's going to put pressure on various sort of parts of the US economy. And, most likely scenario is that some of the shine that the dollar had is just gone for a while, certainly for the rest of Trump's presidency at a minimum. What scenarios, if Trump does come out with hey, it was all just a big negotiation tactic, yes, absolutely, I sort of blew a $5.5 trillion hole in my stock market because I needed someone in China to phone me. Then, yes, we will see further recovery of the dollar. I think the dollar will possibly pull back to about 110 to the euro. That's what, about 4 or 5% stronger than where it's at right now. More likely scenario, though, is that investors look at this and go, you know what, for the next while, I just want to diversify my risk. I can't afford to be that overexposed just to the US as an investment destination. Companies in Europe are a little bit less exciting, but I've got less volatility. Maybe I'll lean into that. And in that sort of scenario, you just see this sort of continued gradual deterioration of the dollar, to the sort of 120, 125 type level. It's not that outrageous. I mean, in my career, I've seen the euro at, I think, 98 cents to the dollar. I've seen the euro at 160 to the dollar. 120 is still sort of mid-range over, a longer period of time.
Thanks, Noel. And while you're on, the DA pulls out or is kind of forced out of the GNU. What actually happens to the bond market and the rand?
So, yeah, again, taking political views aside, the bond market clearly likes having the DA as part of the mix. And we saw as soon as talks start surfacing of, the DA might pull out, withdraw, become an opposition party, you see the bond market becomes uncomfortable. Rightly or wrongly, it's not a political statement. It's more just a function of that's how the market's been reacting. So at this stage, I think, having a counterbalance to ideas, having slightly more market-friendly ideas will obviously keep the market a little bit happier. And losing the DA would definitely unsettle the market. What would happen to the rand and what would happen to bonds? Very much anyone's guess. Last time, if I look at how much risk premium I'd add to the rand, probably trading just below 20 again. If I talk about bonds, I'd say interest rates up about 1% from where they're at right now. So yeah, that's kind of a summary of how the market is seeing things as such.
Cool, thank you. Mike Resty, the Magnificent Seven, the absolute stars of last year, I think they contributed about half of the market return. They came under the most flack when the market came off quite sharply. They got down to valuations weirdly kind of below the median company in the US. Their recent results have been positive. It's only really Apple and perhaps a bit of Tesla that's impacted by tariffs. How would you view those shares, compared to a few months ago?
Yeah, thanks, Pete. It's an interesting question. It's amazing how the market absolutely obsesses about a theme and then suddenly you don't hear about it for a while. And last year was all about AI and tech investment, and suddenly that completely disappeared off the radar, and it was all about tariffs. And lo and behold, we saw a lot of those names pull back 20% plus. I would say certainly the latest set of results, what has stood out for me is the differing themes that are starting to come through, and I think it's becoming increasingly dangerous to think about them as one amorphous lump. And certainly you've got perhaps slightly underwhelming numbers coming through from the likes of Apple, which certainly within our world is becoming a topic of debate. We recently actually exited that position, more out of concern that maybe it's not the growth stock that it's valued as still. So, I think what these results are demonstrating is a need to become much more discerning between each of the businesses. But that said, this has definitely presented an opportunity to get in at, can I call it, sale prices in some cases. And we're emerging quite a lot more reassured broadly by a continuation of decent results from the likes of Microsoft. I think certainly Meta's results were very reassuring. So if there were concerns creeping in, I think that the AI tech theme by and large continues, but be discerning company by company. There are differences there that are important to understand.
So yeah, it's about 2 of the 7 today, Mike.
I would go, I think, Meta, and I would go Amazon, to be honest. I know Amazon's results were slightly disappointing, but I think in terms of opportunity going forward at the current time, those are the 2 that stand out for me. I understand that Amazon certainly is facing some headwinds around tariffs, but I believe that this too will pass. And this pullback we've seen right now presents an opportunity in a business that is incredibly powerful with a lot of optionality, which was some of the things that James was talking about.
Thanks, Mike. And then a last question I'll pose to James. And James, we had a significant event when Berkshire Hathaway came out with the results where Warren Buffett, who's an amazing 94 years old, indicates that he's going to be stepping back from the CEO position, and he's sitting with $350 billion of cash in Berkshire Hathaway. So I'm going to ask you for a moment to step into Warren's shoes as a much younger man. You've probably still got 40, 50 years to invest. What would you do with that $350 billion? And the one caveat is you can't keep it in cash for now.
Sure, that's a tough one, Pete. I forget the exact stat, but he can buy a very high number of the S&P 500 companies with that. So in other words, the window of businesses that he can buy at that kind of scale is actually so small. I think I would probably break with long-running tradition and actually just pay out a really big dividend. And the other thing I guess he can do is just buy back his own stock. But yeah, there's not much else there that he can buy. It's just too big. It's just too much money.
And if you could split it into a few different parts, give us a few shares that you think you'd be comfortable to put in a Berkshire Hathaway type portfolio.
Yeah, again, the size is just a problem. I mean, you're almost forced to go out there and buy something in the Mag 7, which he's just done the exact opposite of with Apple. So maybe an Alphabet. Maybe an Alphabet just because it's so cheap compared to the others. I know it does have some existential threats facing it in terms of its, historic search engine versus going forward. But maybe in view with his tilt towards value, maybe a big stake in Alphabet. But again, he generally hasn't liked tech, so it's a tricky one.
Then maybe either you or Mike, Uber's an interesting one. It's trading at a big discount from the free cash flow and other perspectives versus the other tech companies. But I think the big question mark is, as autonomous vehicles come into force, does Tesla just start their own Uber, or does it keep its place? I know you guys have had a bit of a look at it, perhaps some perspectives there. Mike, I don't know if you or James wants to take that.
Maybe I'll take a brief shot, and then James, you can certainly add in. I mean, there's no doubt in terms of some of our recent inclusions in the portfolio, we've really liked these emerging platform stories. So, we've recently included Uber in our model portfolio for the first time. Flutter in the online sports betting field is another one we've recently added. And certainly our take on Uber is that it is emerging as the sort of dominant portal via which people looking for mobility solutions will go. And it will emerge as a relatively sort of agnostic player in terms of whether you're going in strictly an Uber vehicle or alternatively might want an Uber, sorry, a Tesla autonomous vehicle or whatever the case may be. And we've questioned whether it's likely that the likes of Tesla will want to go through the hassle and non-coreness of running its own fleet and all that goes with it. We think it's more than likely that it will provide the equipment, but look to other people to run those fleets. And so essentially Uber will emerge as the sort of dominant portal. That, and as I say, that's the route that we've gone. But an interesting question, and certainly this is a whole field in terms of emerging platforms across many fields that we're quite excited about as sources of real value creation over the next couple of years. You could look at Spotify as another one that's starting to emerge as the clear leader in its field.
Yeah, I can throw, thanks, Mike. I agree with everything you said, and I can throw in a couple of things as well. I mean, one of the things, the exercise that I do is I look at what implied CAGR is being implied by the share prices of various companies in their free cash flow generation over the next 10 years. And Uber comes out at virtually the lowest of all of those rankings. So obviously the company in theory faces an existential crisis from the autonomous world like Tesla and Waymo. If one is of the view that Tesla and Waymo's autonomous exploits isn't going to wipe out Uber, then it's extremely, extremely cheap. So in a sense, you're almost being partly compensated for that risk. I mean, the other thing with Tesla too is that it just offers an incredibly useful service. I mean, there were some stats that they were talking about recently where they can actually show where when Uber has come into a city, it's actually lowered the accident death toll by a few percent just because of the impact that it has on reduced drunken driving incidents, for example. So, there's something as well that we call the snap test. In other words, if you had to snap your fingers and that service went away, would the world even notice it? And I must say, Uber certainly passes that snap test as well. I mean, probably everybody on this call at some point has been saved from a very tricky situation where you needed to get from A to B in an emergency and you needed to call an Uber. So it's very useful to society. And I think in the end, similar to what Mike says, is that I just don't think Tesla are in the business of running taxi fleets, cleaning them and servicing them. And I think at the end of the day, like we've seen with, something like a McDonald's, where most people who order McDonald's will go through one of the external platforms and not the McDonald's app. I think at the end of the day, the platform that they own is worth so much, and you're being compensated for in the valuation, that it's a very, very exciting opportunity for the next few years.
Okay, fantastic, guys. I think we'll wrap it up there. It's been a great and instructive session. Thank you to all of you. Thank you to the many, many listeners who've given us your time. And if you want the presentation or want to hear any more, feel free to contact your financial advisor or one of the Anchor Wealth Managers. Likewise on the Credo side. Thank you very much, guys, and enjoy the rest of the day.